Hello, chart watchers, and welcome to this Thursday, March 7th, 2019 Market Watchers live show with your hosts, Tom Bowley and Bruce Fraser. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. All right, let's take a look at what's going on in the market today. We have the Dow Jones Industrial Average currently down 228 points, dropping below its 20-day moving average. The S&P 500 down 19. The NASDAQ.
Tom?
Yes.
We need you to share your screen one more time. I got some mountains that I'm looking at.
All right. Hopefully this is a little bit better.
That is perfect. There you go.
Sorry about that. Dow Jones Industrial Average currently down 228 points. The S&P 500 down 19. The NASDAQ down 49, although you can see it is quite a bit off the earlier low. Can we hold the 20-day into the close? That'll be important. And the Russell 2000, which lost its 20-day yesterday, the first major index to do that, is down another 5 points today. The 10-year Treasury yield, look at this drop today, down below 2.65% and back down, threatening the lows that we saw throughout most of February. Volatility index for the fourth straight day, trying to close higher. Higher VIX means elevated fear levels in the market, and that is when we tend to get more selling. So this will be a key index to watch today. Let's see where the VIX closes, leaving a long tail to the upside. Finishing back in negative territory would be bullish for equities, but a strong finish in the VIX later today would not be good for U.S. equities. Materials leading to the downside, strong dollar definitely having an impact on the materials group. Financials getting hit by that drop in the 10-year Treasury yield. You can see also weak action here in the financial space. Apparel retailers, big drop to the downside. One of the reasons Burlington, as you can see over here, reported its quarterly results and really getting hit hard today, down 22 points, which is about 13% from where it closed yesterday. Very big down day on Burlington, and that is dragging the apparel retailers down with it. The food retail group, you can see, also struggling today. The reason there, Kroger coming out with its earnings reports, taking a big hit. So Kroger not doing well, Burlington not doing well, taking their respective industry groups down with them. And I'll tell you what, Bruce, first of all, great to have you on the show, but this market has had a rough week after, it's been probably 10 straight weeks off the bottom where we just kept going higher and higher. Now the bulls are being challenged. What do you think?
Well, thank you so much for having me. It's great to be here, and such an interesting day to join in and be part of this. Actually, part of the discussion I'm going to have today is related to how far up the rally could go off the December-January lows. And we're going to look at some point and figure charts and some vertical charts and see if we can't get a Wyckoffian twist on what's going on. So this will be interesting.
Yeah, it'll be good because I certainly don't know what's going on. So if you can enlighten me, I would really appreciate it.
I'm here for you.
Yeah, no, this is going to be a fun show. It's always great having you on the show and getting a little different perspective, taking that Wyckoff approach, which is, when I look at the way I view the market, I'm sometimes surprised that I am a lot of times in line with Wyckoff and your approach, the way you look at the market. But still, it kind of adds a little different flavor. And sometimes when you get these moves to the upside, you get those false breakouts. And, those things mean something in Wyckoffian terms. And so what I'm really interested in, and maybe we'll talk about this, hit on this during your discussion later, is with the key major indices coming up and testing those October, November, December reaction highs and rolling back over. I'd be interested to hear, and I'm sure we will later in the show, what that means.
Tom, I made some charts just for you.
Awesome.
Yep.
Could you also do some trades in my account for me while you're at it?
No.
Some good ones. Anyway, all right, well, let's get moving here. We do have what's hot, what's not tomorrow. Of course, Mary Ellen will be joining me. Aaron's workshop will be next Tuesday. And then on Wednesday, we've got Linda Raschke joining us. That should be a great show as well. As far as today's agenda, well, we've got, what a great title, Take the Fork in the Road. I love that title, Bruce. So you got a fork in the road, just take it, right? It's got to go.
Okay. What can you do?
Right. You got to go. You got to take it. You got to take it one way or the other. That'll be fun. And then first 10 and 10 stock today will be Foot Locker. So if you want to take a look at that ahead of time, I will annotate that for you later in the show, along with 9 other stocks. And we're going to get a little special taste from Bruce. We're going to let him take a look at all the 10 stocks, and he may have a comment or two from a Wyckoffian perspective on those 10 and 10 stocks. And then we're going to end with what would you do? And I thought this would be a fun one. I took a look. We've got 5 consumer discretionary stocks, most of which I think you're going to be pretty familiar with. And looking at the charts today, if you had to buy one and one only to hold for the next 12 months based on exactly what you're seeing today, which one of the 5 stocks would it be? Go ahead and fill that out. Take a look at the charts and see what you think. And at the end of the show, that final segment, what would you do? Bruce and I are going to talk about these 5 stocks, and we're going to come up with our own pick. And so we'll see how we do versus our audience. So I think that'll be a fun segment. And there might even be a surprise guest appearance who picks one of those 5 as well. But we'll have to wait. You have to wait now and see with bated breath as to who that might be. Anyhow, I know it's just gripping us right now, the anticipation. Anyhow, let's go ahead and jump in.
I know that I'm going to stay to the end.
Yeah, you have to stay to the end. You have no choice.
Oh.
Zach, let me know if he tries to leave the room. Not allowed.
We'll stop him. No worries.
Okay. All right, let's get into the key economic reports today. We did have a few or a couple, and of course the big one comes out tomorrow, non-farm payrolls for February. And we got a little taste with the ADP employment report yesterday, but with the market doing with what it's doing right now, we don't want a real big negative surprise. So we'll see. That'll be tomorrow. Today, however, initial jobless claims came in a little bit better than expected, 223,000 versus the 220 expected. And Q4 productivity also higher than expected, 1.9% versus 1.6%. So what does that mean in the bond market? Well, I'll tell you what, the bond market has been telling us some not great things for a while. And I really thought, okay, here we go. We're starting to break to the upside, and right back down we go again. I still believe this is the biggest concern. If you're trading the S&P 500 or U.S. equities on the long side, this is the one thing that I'm kind of keeping my eye on, because anytime the bond market tells me something different than the stock market, I pay attention, because the bond market tends to get things right more often. And so when you see the 10-year Treasury yield back down again below these moving averages and really not far off that early January low, that is a little bit scary considering how far the U.S. indexes have moved to the upside. So this one bears watching. I would like to see things start to move back up again, but you can see this has been a tough week for the 10-year Treasury yield. As far as earnings reports out, we still had a bunch of them out overnight this morning. They may not be the huge household names that we've come to expect, but we've got Guidewire Software that reported, American Eagle Outfitters, they both reported last night, Kroger, Burlington Stores, H&R Block, Technicorp, TECD, they all reported this morning. And you can see on your screen here, for the most part, we had beats. Kroger and H&R Block both came up a little bit short of expectations. Everyone else beat on that list. And then at the bottom, you can see Costco reports after the bell, along with Marvell Technology and OKTA, which has been one of the hottest software stocks throughout the past year or two. So still a lot of earnings news coming out, but just not those big household names like the Amazons and so forth. All right, let's move on, and let's take a look at some of these reports. So the first one I wanted to pull up was Guidewire, GWRE. And if I take a look at the numbers that came out, by the way, you can look at this chart while I read these numbers to you. They did beat easily on their top line, 169.3 million versus 159.7 million. They easily beat on the bottom line, 34 versus 19. They guided Q3 revenues and earnings per share higher, and then they also raised their fiscal year 19 earnings per share. So everything came in positive. You can see a big gap up here, taking out this key area of resistance. Now, we did sell off, but we're starting to bounce back. I think a close over 96 on this stock, and you might say, well, it's 92, 98. Probably not going to do that. I've seen some pretty crazy things. It certainly could do that. And if it does, I think that would be a very bullish turn of events after selling off from that opening bell. Check out the volume on GWRE. That's why I think the close is so important, because this is not your average everyday volume. This is really heavy volume. So a failure on the breakout, I think, probably would at least lead back down close to the gap support, closer to the 50-day moving average. But if we can strengthen again, then I think the low today becomes a major support level, because that's where all the buying would have kicked in with this kind of volume. So that's why I think today's close on GWRE is going to be important. And of course, this is a stock that's in that software space. It's been leading the market throughout much of 2019 and 2018, and really going back several years before that. Software has been a very strong area. Let's take a look at AEO, which is American Eagle Outfitters. They missed on their top line, edged higher on their bottom line. They guided Q1 earnings per share slightly lower. They did gap down, but they've tried to rally back. It's going to take a close, I'm going to say, above 22 before I would get excited. Otherwise, this is a stock that continues to downtrend, and I would be careful. Kroger came out. They missed on their top line, missed on their bottom line, guided fiscal year 20 earnings per share lower, and you can see gapping down below all of these prior lows. I know it's a hollow candle, but this is problematic, I believe, on the longer-term chart. We'll go to the relative chart. And as you can see, we had topped on a relative basis, Kroger versus the food retailers, back in, I guess that would have been November or December. And we've been trending lower for the past couple of months. Now we get bad news out. And look at that gap down. This gap went below gap support, the prior price lows. I think that Kroger is going to go lower after this report, after guiding lower and then getting this kind of response. So, yes, we got a hollow candle. Maybe we get back up to 26.5, but I think after that we go lower. Burlington, BURL. This is one they missed on their top line. They beat on their bottom line, but they guided lower. And once again, very similar to Kroger, except it didn't open below the prior support levels, but it's certainly trading down there now. There is major gap support right at this current price. This would be a level that if you wanted to take a shot on Burlington, whereas I think Kroger continues to go lower, I think this is an area where you might get a reversal on Burlington. Now, there's a lot of volume, a lot of risk, so I'd be very careful, and I would keep a tight stop. I wouldn't want to give more than 1 or 2% away on this stock if you do try to catch a bottom here, and maybe even an intraday low below 143 and a rally back up above 145 might be a better reward to risk time to consider entry. But this is an area that I wouldn't be surprised if we see a reversal on Burlington. H&R Block, they beat on the top line, missed on the bottom line. Stock had already been under a lot of pressure, was at support, opened at support, and has so far rallied back up. But trying to get through the 50-day has been a little bit of an issue so far today. And then TECD, this was the final one I had here. We did get a big move down after the company reported pretty strong earnings, but clearly this price support level now needs to hold. And that is about the 92.5 area. We went below it intraday, but we've come back up and held it. I think as long as the stock continues to trade above, I might even go down to the day's low at 90. I think 90 to 92.5 is key area of support on TECD, with your target ultimately back up at that 107.5 area. All right, one of the news stories out, Bruce, and I was going to get your thoughts on this too. We had the European Central Bank come out, and essentially they came out with another stimulus package. You can call it quantitative easing, call it what you want, but essentially it's another package of cheap loans to banks, giving them the ability to borrow very low and try to lend to stimulate the economy in Europe. And one of the big beneficiaries of this has been the dollar today. The dollar, you can see, really moving up and breaking out above the prior tops. And, of course, the euro took a hit because of that. From a Wyckoff approach, I guess my question is, do these big picture fundamental news stories like this that obviously have impact a lot of different markets, does that have any impact on the way you look at the Wyckoff, or is this just noise in the background?
I try to think about these things relative. We use the term the composite operator for this sort of large, well-informed institutional investor who's really, really smart in market conditions. And so I try to think about it and go, well, how's the composite operator using this information, or and um, my sense here about what is going on, number one, is that the European Central Bank might be doing this round of QE ahead of this Brexit event, and maybe that they're attempting to convince or coerce the UK into not breaking off. And easy money is certainly addictive, and so that might be something that's going on here. And then the other part is that a weak euro is really good for their exporting economy, and a strong dollar, which we've had recently, is not good for U.S. exports. And so we're in this big trade battle, and there could be an attempt here to drive currencies, drive the euro down to help their economy, and their economy is very slow right now. So there could be something akin to that. And I do try to think about these things, but I always defer to what the charts are saying and let those guide my decisions. And for instance, looking at the U.S. dollar index here, look at this beautiful. Here you can see this has the elements of a reaccumulation type basing structure. And the last decline here in February is slow and halting, which shows that the dollar is being supported well by large interests, could be large banks, and they're looking for the dollar to rally. This could be the completion of a base. You probably could count that with a point and figure chart. And it could be that we're going to get a round of the dollar strength, especially if this rally can jump up and out of this overhead resistance that's nearby. So,
yeah, but the other thing to mention too is that this U.S. dollar index was as of yesterday's close. This is not updated for today's action.
Oh, and there's a gap in there today. Yeah.
Yep, and look at this UUP move today. So I think we're going to get that breakout.
Yep. So that's the way I would do it. I'd look at it and say, does the chart support my view about the economic information?
Yeah, and then of course the flip side of this is, the dollar is certainly benefited, but the euro, on the other hand, when we look at that, you can see it's going obviously the opposite direction, down almost 1% today, and it's a pretty good intraday move on the euro, 1%. I mean, if you look back at the chart, you don't see that very often, and we are threatening, and right now below that November low on the euro as well. And one thing I talk about when the dollar is moving, one of the big problems with a strong dollar is that the materials group and energy groups tend to face stiffer headwinds when the dollar is rising. And the materials are the worst performing group, or at least they were the worst performing group. And if we just one more chart I want to show you, and let's take a look at that dollar and stretch it out over the last 15 years on the monthly. And you can see since 2011, this dollar index has been in an incline. And when we look at the XLB relative to the S&P 500 over that same time frame, and I get rid of all the candles make it very difficult. But if we, and then we can also move it to weekly, I think that'll show. So if we do a line chart on a weekly basis, look at where we topped on materials relative to the S&P 500. 2011, the same time the dollar bottomed. So as the dollar's been rising, it really puts pressure on material stocks to outperform the S&P 500. They generally don't. And so when we see a big pop today in the dollar, it's not surprising when you see materials is the primary laggard to the downside.
In such a strong economy that we have domestically, we forget oftentimes that the rest of the world's in a very slow economy, and that we're basically have been importing, or through our trade negotiations, we've been importing GDP into the U.S. And so to see materials in a relative strength downtrend is something that we wouldn't generally expect to see in a late cycle bull market, because in late cycle is when you see inflation and materials doing well, And we have just the opposite. We have very strong dollar. We have weak materials, and this, I think, says that the economy is maybe tired here.
Yeah, and I think the other thing is those who maybe don't follow technical analysis. I think this chart really paints quite a picture here too, because the S&P 500 and the German DAX tend to be somewhat highly correlated. You can see for a period of about 9 years, we stayed in a pretty narrow range when we take the price relative of the S&P 500 versus the German DAX. But look at what happened in 2018. The S&P 500 is breaking out, and I think what the dollar is telling us and what the 10-year Treasury yield's been telling us here in the U.S. versus Germany is that the U.S. Economy is much stronger. And so that kind of gets back to your point. So we've been seeing the S&P 500 outperforming because we do have a stronger economy based on just about any measure, I think, that you look at. Now, I think this is a good lead-in for your presentation today, Bruce, because I know you're going to talk a little bit about the S&P 500, but on a relative basis, the S&P for the last, I'm going to say 15 to 18 months, has been wildly outperforming most areas around the world. Maybe not all areas, but most areas. And I think it's obviously because we have experienced more economic growth, and maybe it's because we started the QE earlier. A lot of people, we could debate that back and forth. But I'm going to let you take over from here and give us your thoughts on taking the fork in the road. I've been waiting for this because I need to take the fork in the road, and I'm not sure which one to take.
Well, I'm doing this as therapy. So I'm looking forward to talking this out. I have to talk out my Wyckoff conundrum with everyone here so that I can see if I can, with your help, figure out my problem, which is being at the fork in the road. And so let's.
Yogi Berra is one of my favorites. He had so many great lines.
Yeah. It's like the other one I was thinking about was nobody goes there anymore because it's too crowded. Yeah, that's what it's one of. So there's so many. There's so many. So,
yeah.
But a brilliant guy, 13 World Series, just maybe the best catcher to ever play the game. Just a wonderful human being, and I call him a Wyckoff expert. I doubt that he ever knew who Wyckoff was, but for his wonderful witticisms, he's got to be a Wyckoffian of some kind. So anyway, so here we go. First of all, I want to make an announcement. The TSAA SF is this wonderful society, not-for-profit, oriented towards technical analysis, education, and it's just a great organization and very devoted people that are running it. And we just announced yesterday our speaker for March, and he's a Wyckoffian and just a wonderful person, a wonderful educator, a friend, and I'm thrilled that he's going to be on the speaker docket for March. And this is Gary Follett. So you can go to the website. This is a member event, but membership's only $75. And there's something going on constantly through the year. And our officers are always working to do more to make the organization relevant to its members. So check it out. Okay. And so take the fork in the road. This is actually a blog that I wrote back in 2015. And it was about really about distribution. But I really have, and please go back and look at these. You can go into the archives and see the different blogs that we're doing. But what I have here is I have two events that I want to discuss relative to the current market, and see if I can, through this Wyckoff therapy that we're going to do today, see if I can organize my thinking about what to do given the place that we're at. So this is a distribution schematic. We'll come back to that as time goes on, but you're going to see a family resemblance in this to the current market. And here is a reaccumulation trading range, which I actually did a power charting episode that you can see about a week ago. So go back and look at that in the StockCharts TV channel. And I talk about reaccumulation structures and look at case studies. So I believe we're in one of these two conditions, and I would like to have a discussion about how we can tell which one we're in. And the whole idea about taking the fork in the road, Wyckoffians are tape readers. So I want to say that I have a bullish bias. My orientation is towards rising prices, because that's the long-term trend of the market for decades. Yes, there are some bear markets that come along. So, but my bias is bullish, but I'm a tape reader, and I let the market tell me where it wants to go. That's the Wyckoffian way. So let's see if we can get the pulse of the market from a Wyckoffian perspective here. And I want to go back and do a little review. You'll see at the bottom of these charts the where this chart came from in my blog post archives, and you can go back and look at these, pull them out, blow them up, and so on. But here, this Dr. Pruden was my teaching partner, my mentor for 35 years, almost 40 years. And Dr. Pruden was an amazing Wyckoffian, an amazing point and figure analyst, and he did a point and figure study of the stock market back in 2003 and made an amazing call using point and figure analysis that got within 200 points on the Dow of the final high from the lows back in the prior bull market of the early 2000s. And then he did it again here in 2009. And this green line here represents the area on the vertical chart. I will show you the point figure chart in a minute. But the green area represents the count that he took initially off the 2009 lows, and made an amazing call, because the Dow was, at the point he made this, did the study, the Dow was still under 8,000. And he said, based on point figure analysis, that the Dow Industrials in this case could get up to 17,600 to 19,200. So I replicated his count for the blog that I did, Point and Figure Pie in the Sky. And look what happened. We had this glorious uptrend. And this is when people were just very bearish on the market. As a matter of fact, it's the most bearish period I've ever seen in my career. And look at where the market went to. It got right up to the between 17.6 and 19.2 and hit the wall. And so it got above the trend channel, spent some time up there, couldn't really pull away from it, stopped there, and paused for 18 months. And this 18-month pause was a significant period of volatility for the stock market in 2015 and 2016. At that time, I wrote, at the conclusion of all this, at the point of this last bar here, I wrote this point and figure pie in the sky, and with Hank Pruden and Roman Bogomazov and myself, we did this analysis and said, can we make this count bigger, which is a normal procedure in point figure analysis. So this count worked, the green one. We stretched it out and said there's a bigger count here that we can take. And this count went 22,010 to 23,000, call it 700. And then we had what we call a reaccumulation count, which went in this 2015-2016 area that went 22,850 to 24,483. And at the time, the Dow was at 18,568. And people thought that I was getting way ahead of myself, that I might be actually trying to participate in the cannabis movement too early. But in fact, I made this analysis and wrote this blog. I was very sober. And I was thinking people are just going to think I'm nuts. And so this count, 18,600 to 22,850, 24,483, this count pretty much confirmed, this big base count pretty much confirmed this reaccumulation count. And so we can see here that this is the area of the reaccumulation count in green. And so what happened? Well, first of all, let's look. I will let you go back and study this chart, but I do want to say one thing about it. This is the chart that I assembled back in 2016 for that blog, which replicated Hank's count in green here and then the larger count in red. But I had two more columns that I could legitimately count here, and I put those on today, and that took the count up to 22,900 to 26,358. And so this is the larger count. And let's move on. And here's what happened. And so you can see that this count here was largely fulfilled. It got right into this area. This count, it went right into the area of this climactic surge. And notice how this was a huge buying climax that went up to the January 2018, and then had a large reaction. This set up a range-bound condition. We'll look at this a little closer in a minute. And I said at the time that I wrote this blog that the Dow was becoming climactic. This data here is since then. And we can see that these counts did a really good job of targeting the range where the market went to, and the market just hit the wall. So we also keep in mind this larger count that went to like 26.6. Well, I believe that the high was just at 26,900. And so it got very, very close to the final high if we stretch that count a little more, which we didn't need to do because it still worked really well. Okay, so this is the count of the 2015-2016 area, and you can see that this is in More Pie, Bigger Sky that was published in 2017. And right when it broke out, we said, okay, this is how far this could go, 22,850, 24,483. And so do go back and have a look at that. Now, I want to shift gears here, and I should keep track of the time because I want to make sure I don't go over, but we're in good shape for time. So this is the big question currently off the December 24th low, was where will the current rally pause? You may have seen me do some work on this in a blog I just published, and also I did it in power charting. I looked at these. This is brought up to date through today. You'll see here that Wyckoff draws trend lines differently than most other technical methods. And the Wyckoff method is really oriented towards using trend lines and channels for trading purposes. So you can see here that what we try to do is we try to draw off the two important points that come up very early in an uptrend. So these square boxes here represent the two adjacent points that we draw it from. I have a full description in this recent blog that I did on trendline drawing, so please have a look at that. And then on the intervening low, or otherwise the high, if you draw it the other way, and I'll show you that in a minute, you draw a parallel. So you're drawing the parallel of this line, the solid line, off this intervening low, and that 1 point. So there's only 3 points in trendline drawing in Wyckoff. And you can see here how beautifully this came up to the top of the channel, threw over it a little bit, and then came right back down to the bottom. And then you can see here from this trendline analysis that the rate of advance is slowing. And let's zoom in. So you can see here we drew a new trend channel here off this point and the intervening low, and we can see that the rate of advance is slowed. Well, look at how well both of these trend channels were respected. So here we can see that it rode along the bottom of the green oversold line, we call this, for a period of time, and then it dipped below it, stayed below it. The slower trend channel came into effect, continued to be in effect, and it was riding along the top of that. Rallied up to, on a gap, up to these two trend lines together, and that was it. And since then, it's been cascading down. It's gotten to the slower trend lines, oversold line, and now has fallen through it as of this reading that we took today. And so this is the condition that we have. Let's move on. One thing that I'd like to point out is this downtrend line. This is a classic downtrend line of this December decline. 2 points, intervening low, trend channel. Look what happened. This is classic when you get into a selling climax area or a buying climax area. Look at the failure of the channel, oversold, and a throw under of the trend channel. This is a classic place where exhaustion occurs. It happened beautifully on this 2-hour chart. And then look at the change of character in this rally. It just turned up and went right up and out of the downtrend channel and off to the races it was. Okay, so now we're going to go to a weekly chart, and we're going to use completely different time frame to draw our trend channel. And so here you can see this is what we call a demand line. This is the normal use of trend lines, which is draw the demand line first, unlike the last example, but we draw them however we can do it. So we just find trend lines and draw them. We can usually see what the primary trend lines are very easily. 2 adjacent lows, intervening high, demand line over bought line. Well, look what happened. This is the beginning of 2016. So this is a weekly chart. And you have this dramatic run up and throw over of the channel. And this is January of 2018. We wrote blogs about this. Look at the failure off this buying climax. Very clearly, this was a buying climax and a failure. Well, the failure was a very sharp decline. It only took 2 weeks. Look at the volatility here and the huge volume. Well, it went right back down to the demand line, bottom of the channel. And then it rallied again, rallied up to the top of the channel for a secondary test. And in Wyckoff, we're always looking for these three places. And this is important here, is we look for 3 places to show, 3 events that show that a trending market is becoming a range-bound market. Buying climax, automatic reaction, secondary test. So we have these 3 events here. Now we go from trending to a trading range. And then in the evolution of the trading range, we attempt to determine whether we're seeing distributional characteristics as the trading range matures, or we're seeing reaccumulation for another move up, which we saw in that 2015-2016 example. Okay, well here we can see, and this is something I really want to focus on. Buying climax, automatic reaction, secondary test. We pointed this out at the time that it happened. And we draw a resistance line at the buying climax and the secondary test. We have a throw over of the upthrust into an upthrust here, and then a massive failure that is a major sign of weakness down and out of the range, which produces an important rally back up into the trading range and upward. Now, what I want to point out is a couple things. The demand line held here. It held all the way through here, which was a number of attempts to go below it. It held beautifully. These were buying opportunities. That's why we do trend channels. This was a selling opportunity throwing over the top. And so here we can see a rally up. It can't get back to the top of the channel. It goes above the resistance area briefly, 6 weeks, and then fails. And it has a massive failure, but it fails not only below the resistance line, fails below this resistance line, and it fails below the channel. It's out of the channel as of the last part of the year, October, November, and December. Well, look what happened at this resistance, 2,800 on the S&P. It touched here, had a sharp break after it rallied to this area from underneath, rallied here, touched, had a sharp break, rallied here, touched, had a sharp break, rallied here, had a much bigger break. And so 2,800 is a place where sellers are supplying the market with stock, and look what happened. Look where we are. All of a sudden, so we're asking the question, where would this rally stop? And so we pointed out that this was an important resistance area and a classic place for the market to go back down again, and that appears to be what's happening. Okay, so now the last thing I want to make here is that looking down at this area is we could very well be here at this upthrust, and this weakness that we've just had down through the support area and a rally up could be setting up a condition for a run up to another high. Even under distribution, we could have another high here, and I think this is an important scenario to consider. And so maybe we get a pullback, and I'm going to talk about how this pullback could develop in a minute. And
hey, Bruce.
Yeah.
Okay, so if you look at that 2016 to 2000, or late 2016 to 2019 advance, you had I think on the other slide you had that trend line drawn. Yeah, right there. Now on that advance, I mean the S&P 500 gained probably about 65% in 2.5 years, which we both know, and I think everybody listening knows, is an unsustainable channel. I mean, you know that channel is going to break at some point because the stock market doesn't go up at that kind of a rate for very long. It's just not possible. So how much of this, when you see a trend like this, are you anticipating that break, or do you just say we're just going to ride it until it breaks?
Great question. What I would look for in the Wyckoff structure is a buying climax, ideally a buying climax with a throwover of an important trend channel. And so this is exhaustion. Usually when you get a move of this magnitude, it's going to have a climactic exhaustion move at the conclusion. And this is exactly what we saw here. And it was dramatic. It was a huge move in December, January of 2017, 2018. And then, but the more important probably answer to this would be that after you get the buying climax is that you have a sharp break that is greater in magnitude and volume than anything that preceded it in the uptrend. So if you look at any of the reactions, all the reactions in the uptrend are pretty reasonably modest until you get to here. And this decline is of a magnitude different than anything that preceded it going back to late 2015, 2016, which started the uptrend. And so this is what tells us the combination of three things: the buying climax, the automatic reaction, and the secondary test tells us that for the time being going forward, we're in a range-bound condition. And then we assess the range-bound condition for whether or not it's reaccumulation or distribution, and you can trade that. We actually did point figure analysis of these areas in here and got great counts. I actually have some examples here, but I doubt I can get to them today. But this count took us right up to the upthrust peak. And so this was very tradable, but the rally in and of itself was, you know, a standard rally, nowhere near as dynamic as the rally that preceded it. And so there was an element of weakness in this advance that suggested that there was some selling going on, some large sellers using these rising prices to sell stock. And then of course it was confirmed by the sharp decline that came after. So, but these 3 points, bind, climax, automatic reaction, secondary test, would be the evidence that would tell us this is where we are. That we've changed the nature of the trading in the market for the time being.
Okay. We did have a couple questions, and I know we're going to probably have trouble with time, but maybe these are things that we can think about for future appearances when you come back. One, well, the first one is on Renko charting. Can you compare and contrast Renko charting with P&F charting? And then the other is, and this is one we probably will cover on Market Watchers Live from time to time, or we can cover. But the second one is the dollar is breaking out the new highs today. Why is the bond market doing so well at the same time? With normally the yields go up and that strengthens the dollar. But I could just briefly say that on the second question that it really has to do with our bond market versus foreign bond markets. And I haven't looked at, for instance, Germany. But I do know that the dollar has been going up over the past 10 years, mostly because our yields have been going up faster than Germany's yields, the yields over in Europe. And so that tells me that our economy is stronger, and as a result, we get the stronger dollar. Now, I haven't looked today to see, but I have a feeling based on what the ECB came out and said about, that the lackluster economy in Europe and seeing what's going on with the euro, I can only imagine that even though our yields are dropping, money going into treasuries, I think that probably the yields are dropping even faster in Germany. But again, I haven't looked at that yet today, so might be speaking out of turn. But that to me would be the reason why. But do you have any comments on the Renko charting?
Renko is not something that I do, but I do know a number of Wyckoffians that use them and like them. I find that point and figure charting, classic point and figure, does such a good job. I'm so comfortable with them for doing price objectives that I really just spend all my time, more time on point and figure than on vertical charts like these. But that's just my preference. But I do know a number of Wyckoffians that really love them.
Yeah, and I'll just add that I know Renko charts really don't pay any attention to time, that it's really just about the price changes that meet certain requirements.
And that's a point and figure phenomenon too, in the way they're constructed.
Yep. And I think Renko uses bricks, whereas point and figure kind of has the boxes or whatever going higher.
Well, yeah.
So anyway, just wanted to point that out. So, but maybe that's something that maybe for a future show we could use as a topic, because I know that question comes up from time to time.
By the way, there's a point and figure workshop that I did last summer, I think it was, and Zach and the crew put that 2-part point and figure series up often, and look for that and play it to get sort of an overview of how point and figure works for horizontal counting method. And so look for that in StockCharts TV. So finally, I just want to show this monthly chart, because here's again another different view. I find this chart amazing, actually, and that is look at these 2 points here. This is the low in 2009. Here's the next important reaction. Big, very long demand line, 10 years in the making. And this got very close to touching at a great place to find support and rally. Look at the rally that came thereafter. This is the area that we're in now. We'll look at, if we draw this trend channel here, look at where we are on the monthly. This is a monthly bar, the last bar. It's right there. This should be important resistance right here. So these 3 trend charts all have elements of resistance that the S&P is right at this 2,800 level. And in fact, we are starting to see weakness. You can go back and look at this chart in this recent blog. Now what I want to do is finally, I'm just going to breeze through this. This is not in a blog. I actually did this chart for today. But this is the base 30-minute chart, 3-box reversal. I used average true range scaling. These are great tools in StockCharts point and figure charting engine, and counted this 23 columns, and these 23 columns gave us a count: 26,075, 27,012. And you can see that, look at what happened. We draw a trend channel on the point figure. Look what it did at the end. It threw over, became overbought. That's classic overbought. Now it's pulled back in. I don't have the most recent data, but I believe that we're out of the bottom of the channel. Big change of character in the way this is trading all of a sudden. And this is just using 30-minute data, and captures the whole move up. And we fulfilled the count. We went into the area of the count range, and a change of character. So this is like I call it a trifecta. Point figure count fulfilled, went up to resistance. It's at the resistance I showed on the prior 3 charts, and then there's a trend line throw over. And this is a classic overbought condition. Great place to probe the market or to sell some stock. Okay, and then what I want to do, and I'm going to do this really fast because I want to get it in. I'll pull these up. There's 3 important rallies back in 2015, 2016, and we studied this in the blogs. You can go back and look at these. But these rallies may be akin to the rallies that we've seen, the rally we've seen here in the beginning of 2019. Very sharp, persistent runs upward. Well, there were 3 pauses, and I want to just offer this as a scenario for what could happen. In this case, there was a pause. These produced really good point figure counts. This base, this area in the orange, and then downward to another base. These were great counts, and this you can see. Look at the volatility. Volatility is very high throughout this whole period, and then it just collapses back down again. This looks like there's distribution going on because of the sheer volatility. We're looking for absorption of stock in the pauses. And this next area here, look at the difference. It goes sideways throughout, does not break down, and stays in the top third of the prior run up. This is what I will be looking for after the recent run up into the recent highs that we've just had, is that we have, look at how the volatility is much diminished. It takes more time, more bars, and they're smaller bars to go down. Really good bullish bar up, 3 bars down. It sprung the low, but the big clue was, because this is a spring, is if it springs the low, and then look at this bar, it comes, produces a tail, has a big run up, closes very near the highs. And so this is a very big clue that this is a reaccumulation, that a backing up action, we would call it, that is going to go higher. And then it did it again. Again, this has much less volatility in it than this area in the orange. And you can see, sprung the low at the end, turned around and had a big bullish bar, closed very close to the high of the range, and it was up and out. And so these big reversal up bars after a spring are the clue that you should get busy, and that this is there's a bullish tone to this market. I'm going to suggest that this is what to look for from here forward, is to confirm that this rally that we've just had is a rally of where stock is in very strong hands, and there's an attempt to pull back, which we're in now. Probably be the most volatile part of this decline will be the part that we're in early, and then it starts to become dull and quiet, stays towards the top of the range of this recent rally, 19% move up, stays in the top third, and then does something akin to the blue box and the yellow box, and attempts to then run to the highs. This is what I'll be looking for as a bullish bias. The thing that I would be worried about would be if we break down from here and go right back down to the support of the automatic reaction in February of 2018. If there's weakness, big wide-ranging bars, ease of movement down, very high volume, this I think will say that we're in a distributional type structure. And I'm going to let the market tell me. My preference is to see something akin to these last two pauses. This whole area here from the blue over to the middle of 2015 was a beautiful point figure count. It's the count I showed you earlier that went up to 24,000. Okay, we are about out of time. And so I want to show you, if I can, this chart. By the way, tomorrow I'm doing a power charting on contrary opinion. This is the most brilliant chart schematic that Hank Pruden authored, created, and it took me months as a young technical analysis student to get the hang of this chart. But it's so good on all the elements of price, momentum, sentiment, volume, and contrary opinion, and how they all fit together. We're going to have a big discussion about that tomorrow in the new power charting episode that's coming up at 3 p.m. Eastern. Okay, last thing I'm going to show you, I'm going to do this really fast, is this is a sentiment index, which is going to be discussed tomorrow. Excuse me. And this, Joe Turner in early January presented this chart, and the reading here was like 3 or 4. There's 7 sentiment components in this index, and this is about as low as you can get. The most fear that you can get in a market was at the January lows. Well, look at how fast the fear became greed, and using CNN's terminology. And the reading went from about 3 or 4 to 72. Currently, I think it's 63 as of today. 19% move. Look at what happens when you get these extreme fear readings below 20%, is you can have really large swing moves. And you see here that this index gives you 2 to 3 good junctures per year of extremes of extreme pessimism or extreme optimism. So you can go check this out on your own, but it just reached 72, which is a very high reading. It happened very fast at the beginning of the year and produced a 19% gain. Well, we've used up a lot of the fear, and now it's become, it's flipped. And lastly, and I thank Pring Turner for allowing me to use these. Joe Turner is a brilliant model builder. This is one of the models that Pring Turner has constructed. This is the fuel tank. The fuel tank was 96% full at the beginning of the year. So a lot of fuel for an important move. And we saw that was about a 19% move. Well, now you can see when it gets under 20%, the fuel tank is pretty close to empty. And so you can see here the empty, what happens when the tank's full and when the tank's empty. And here you can see this all occurred in an uptrend, good upside bias. This is the New York Composite. Notice the downtrend in the New York Composite, lower highs, lower lows, and we have now used up most of the fuel in the tank. So I believe that an overbought condition should be treated very carefully. And lastly, Pring Turner does publish a lot of their research, and this is our Martin Pring at StockCharts.com, and one of my mentors and one of my dearest friends. Joe Turner, one of my mentors and dearest friends. I've known them for 3 decades, more than 3 decades. They publish their research, and you can go to their website and sign up for their monthly newsletter. And I'm going to end right there because my time is up.
Yeah, we're going to move on to the 10 and 10, but just one last question, and that is, if you've been on the sidelines waiting for a pullback, do you think you're going to get a better opportunity than right now?
Yes, I think that this pullback, if we get the backing up action, which is halting and slow, I think it could take weeks, a number of weeks to unfold, to process this advance we've just had. And I hope that it's shallow, non-volatile, shows elements of absorption. And I think that the opportunity, remember the springs we had at the end of both of those examples I looked at, we may or may not get that, but that would be a great time to get busy and start to look for the next leg up in the market. And so I don't know that I've solved my dilemma, but I appreciate you all listening to me here. This has been like Wyckoff therapy for me, and I may not be any clearer on what's going to happen, but I feel better.
That's good. I feel a little bit better too. So, and we're going to have you back for another therapy session, in another few weeks. So, this isn't the end of it.
Oh, good. Thank you. Well, this did help.
All right, I'm going to move over. Let's go through these 10 and 10 stocks pretty quick. As I mentioned earlier at the start of the show, Foot Locker is our first pick. And Foot Locker, you can see the gap up with earnings, huge move up. It has pulled back. I actually like it. And a lot of times what I look for on these gap ups with earnings is what the character is of the candle the day that it comes out. Does the stock completely sell off after it gaps up, or does it continue moving higher? Because you have to remember, market makers are on the other sides of these trades. So when they gap up and it continues going higher, that to me suggests some really strong accumulation signs, and especially if the volume is off the charts. In this case, however, Foot Locker gapped up and came back down, which to me suggests we're probably going to be somewhere in the 59 to 61 area. Maybe that 20-day moving average that's been very strong in 2019 is support. I would be looking for that. The apparel retail group's just been okay in 2019, showing a little bit of relative strength, but still well off where it was back in November. But Foot Locker's been one of the best stocks. So if we could get some strength in the group, then I think you're going to see Foot Locker make another run back to the upside. But I'd be looking for a bounce maybe off that 20-day and eventually another test up there around that 68 level. Zach, what else you got for me?
The most popular stock in the chat box was ECA. I believe this is something that Aaron looked at for an upgrade or a downgrade a couple days ago.
Yeah, in Canna, and I don't like it. And the reason I don't like it, and we talk about this all the time, again, if we use these relative charts and you look at the stock and you look at the group that it's in, the group has been weak. I think when you look at the stock relative to its group, it's been weak. You look at the stock relative to the S&P, obviously weak, and then its peer group relative to the S&P weak. So it's hard for me to really get excited about a stock that's in this kind of a situation. Now, volume trends seem to be picking up, but I think I would have to see a breakout above key resistance, and I'm going to draw that in here at about this gap resistance level here, 7.5. We got close. We're trying to hold the 20-day. We'll see if we can break out. I think it's too early. I would pass on it.
All right, the next stock we have is Disney. DIS.
Right, Disney. Disney, I think, is showing some pretty good signs. Obviously, the overhead resistance at 118 is a little tough, and you can see that it's a little challenged on a relative basis. It's been going through a little weakness, but that's kind of been the pattern of this stock throughout the entire year. Just it rallies against its peers, then it weakens against its peers. I'd say it's just going along for the ride for the most part. So the overall group relative to the S&P 500 has been pretty strong. So I think we're going to probably make another run on Disney back up toward that breakout level, those prior highs. Oops. If we can draw that line right in there, I believe we're going to make a run for 118, 118.25. To the downside, watch the 20-day. The fact that it has been holding recently on weakness, I think, is a good sign. So I think in the short term, it goes for 118. I would, if I had to take a position, I would be on the buy side here on Disney.
All right, our next stock is Canopy Growth, CGC.
All right, CGC. It's funny. I was talking to Greg Schnell yesterday, and we were talking about some of these marijuana stocks and how a lot of things are built in. You think that there's tremendous growth opportunities, and there are, but there's going to be a lot of companies coming in trying to claim some of that. It's really going to be hard to see how this all shakes out. So what I would do is pay attention to the technicals, and if they break down, I wouldn't be, trying to cling to the fact that, hey, maybe this is one's going to be the one that makes me $1 million over the next 5-10 years. What I would be watching, I think you've got a symmetrical triangle, and if you connect these highs coming down here off of this uptrend, you got lower highs, you got higher lows. I think it's squeezing in this triangle. Let's see which way it breaks. If it breaks to the downside, especially with a spike in volume, then I would be much more cautious to stock. Otherwise, for now, I think it's just a hold.
All right, our next stock is iShares Silver Trust, SLV.
I can tell you I'm not going to be a fan of silver. I'm not going to be a fan of gold. Talked about this a lot. As long as that short-term trend was up, I was okay. But you have to remember that the long-term trend of the dollar is higher. And anytime the dollar is trending higher, the long-term prospects for gold and silver, especially on a relative basis to the S&P 500, I think are very weak. I think we've now seen a breakdown here that I would be extremely careful. We could draw a trend line. I'm not going to do that. But the two key support levels have been lost on this uptrend. And given that long-term relative downtrend line versus the S&P 500, I would say sell silver.
Okay, our next one is Xilinx, I believe is how you pronounce it, XLNX.
Yeah, this is a really strong stock. I'm going to say it's I'm going to say it's the strongest stock in the semiconductor group. And I honestly believe that today's test of the 20-day moving average is an opportunity to enter. You can keep a fairly tight stop, but after the gap up with earnings, it's continued moving higher. It's pulled back with the overall market. I think that's setting up as an opportunity. You could keep a tight stop. If it closes below the 20-day, you can get out. But I think this one's going to make another run back for that 126, 127 area.
All right, four more. We have Palo Alto Networks next, PANW.
Yeah, another one I think that came out with strong earnings recently, if I'm not mistaken. Yeah, and the gap up. And this thing came right back, tested gap support and the 20-day moving average. This is a classic. I'm actually kind of disappointed that I don't own it based on this. But this is what I look for. I love stocks that come back, test that 20-day, and also you can see the gap support. Notice the candle. Remember what I was talking about with earnings? If it gaps up and it keeps going higher, then it generally doesn't come down and fill. But if it gaps up and it struggles, then wait and see if you get that gap fill or the 20-day test. We got both, and now it's starting to turn higher. I like it from here.
Okay, our seventh stock is Crocs, CROX.
All right, I think.
Sorry, eighth. I'm counting wrong. We have 3 left.
Okay, so that's our 8th stock. All right, so Crocs, big gap down below prior support. This one's got some work to do before. If I was in it, I probably would have sold. Well, I probably was sold for earnings. I think that was earnings related. But I think there are a couple things that I would watch for here. On this gap down, we gapped down below 26. We traded as high as 27 that day and then sold off again. And you can see the volume. So I believe that is a very significant price resistance level, also where you opened on the gap. So I'm going to say 26.25 to 27. You can see that 20-day moving average also coming down into that area. I'm not going to be overly excited, Crocs, until we break out. Now I'm going to give you the good news. The good news is that there was major gap support on very strong volume back in November, and that has held so far. So I think we're range bound. I'm going to say $23.80 up to about $27 is the current range. If you break to the upside, I like it. If you break to the downside, I don't.
Okay, 2 more. CSX is our next stock.
Yeah, another thing I talked to Greg about were the railroads. He said he looked at 20 transport stocks and he only saw 2 that he liked, and CSX was not one of them. I actually am a fan of CSX. I am a fan of the railroads in general. So I'm going to pull up the relative chart here, and we will take a look. First of all, you can see that the railroads did break out above the prior high, and they have pulled back, so we want to be careful and watch. But I think a normal pullback is not that bad. Railroads relative to the S&P have been extremely strong. CSX relative to the S&P also strong. The problem has been that CSX is not one of the best railroads. That relative strength has picked up here over the last 5-6 weeks, really since back third week of January. We've been seeing some strength. So can we make a breakout? So if I was going to annotate this, I think railroads are good. I would agree with Greg in that there are probably other railroads that look better than CSX. But as long as CSX holds this rising 20-day right here, I mean, you can see as we go back in time over these past couple months that every time we come down and we challenge this 20-day, we get the buyers to come in. So I'm not going to give up too soon on this one. I'd like to see it bounce off the 20-day and then break out.
All right, and then the final stock in the 10 and 10, Pyxis International, PYX.
Yeah, this one was absolutely crazy from what I remember. Huge move up, all the way back down. It broke back out to the upside, getting your first 20-day test. So on this one, what I would simply say, this is a crazy volatile stock. So keep that in mind. It's not something that I would be putting 10% of my portfolio in. This would represent a very, very small portion if I traded it. But if I were going to trade it, I'd trade it right here on this 20-day test. Beautiful move up. Volume's been picking up. The momentum's been strong. We're getting our first 20-day test since we had this pickup. And I like the fact that this actually went a little bit above this reaction high over here. So one final line I'll draw in here. That move up above 27.5, I think, is significant. We did fail short term, but I think this is where we could bounce from. So I could take a position here on the 20-day, but I'd keep a tight stop. And that is it. Now, I do, before we wrap up, just one question to Bruce. I know we only have, maybe 30 seconds or so, but did any of those stocks that I just looked at stand out to you in any way on a Wyckoffian basis?
Xilinx and Palo Alto Networks both have characteristics that I really like, and that is that they were really strong in January, February. So they helped set the pace for the market as a whole. A lot of the stocks that did poorly, CSX also I thought was great in that regard. Mm-hmm. The stocks that did poorly, say on their earnings, were stocks that already were performing poorly in January, February, were relative strength laggards. And those are stocks that when earnings came out, for the most part, they didn't do very well. The one that stood out was, I believe it was Foot Locker, the first one. Foot Locker, is that there's a stock that was lagging on the way up, looked like it was making a reaccumulation type basing structure. It did jump out on earnings, but I'd be very careful of that stock simply because the volume surged as it jumped out, and it's starting to show some weaknesses. It's pulling back down to the breakout area, and and it underperformed on the way up in January, February. And so I think those elements together. See, it's like, look at Xilinx here. Beautiful leadership posture in the stock on the way up throughout. And then also notice that in December at the lows, it was making a higher low to the October low. And so just great stride. This would be a stock that I'd be looking for to, if we get a good backing up type action in the market, I'd be looking for Xilinx to back up less, show some relative strength in the weakness of the market, and look for a buying opportunity. Same thing with Palo Alto Networks. Same thing with CSX.
Okay, awesome. All right, let's get into this final market update. We want to get to the what would you do segment. So I'm going to do a real quick update. First, let's make sure I've got the most recent numbers here. You can see the Dow Jones has been cutting its losses since earlier this morning. Dow Jones now only down 130 points, still down, still red, but certainly off the lows. NASDAQ also trying to rally back off the earlier lows. We were down below the 74.20 level. Now we're back up 74.65, still down 40 points, but trying to make some headway back to the upside. The S&P 500 also rallying. The one thing I would look at on this rally is that the NASDAQ right now is trying to hold that 20-day test. We went below it intraday, but if we strengthen into the close today, I actually like this candlestick. I like the fact that we pulled back in somewhat reasonable fashion, tested that 20-day moving average. It looked like we had an intraday break and then rallied back up over it. So I think the market right now isn't that bad, but we need to see how we close later today and see whether or not maybe the weakness is going to continue into tomorrow. And, of course, we do have non-farm payrolls out tomorrow. All right, we're going to move into our final segment, and that is what would you do? And you have a poll. If you haven't already completed it, please do so. It's a very simple poll, 5 stocks in the consumer discretionary space. And if you had to buy one right now based on current technical conditions, which one would it be? Bruce, you've got probably about 4 or 5 minutes here, and then I'm going to take 4 or 5 minutes. What do you think? What would be your pick among those 5 stocks that we listed?
Okay, so I'm going to take the screen and So here's Amazon of those 5 stocks, and I actually think that Amazon looks a little troublesome. It's had a decent start to the rally, but look at how it's flattened out. It's not participated in the February advance. It's not showing leadership. It's got higher peaks in November and December that it can't get to. And so that is worrisome to me. I think that Amazon needs a lot more work before it's ready to really go up. And then Starbucks is one that I like a lot, actually. It's pretty strong right now. And you can see, look at how it's done in January and February. So a really good advance after a really nice advance from June onward. And so it showed really no propensity to really break down and be weak with the market back late in 2018. And then the only thing that I could that I would want to add here is let's look at the weekly, because I just want you to see this. Look at this potential reaccumulation type structure with the spring at the end, and then notice the remarkable change of character as it just marches up and out. Then it backs up here. Now it's starting to rally again. Given an opportunity, this would be, I think, a stock that could be a good campaign stock for the future. AZO. This is a stock that did quite, as a weekly chart, did quite well in 2018, led the way, much stronger than the market as a whole. I think this is a stock that shown good strength. I think I would expect it to continue. Look at the relative strength down here. This relative strength is just persistently in an uptrend. Institutions that have good stocks, good relative strength, are just going to keep giving love to those stocks in the form of new money. And so AZO may need a pause in here pretty soon, but I'd be looking for an opportunity to buy that. Nike. So Nike's another stock. Look at this beautiful reaccumulation here. Has a big count in it. This is weekly. Counts higher than where it is now. I would be campaigning the stock for a potential run up to the count area here, which I don't recall what it is at this time. But it's up and out. It's been leadership. It's continued to act well. It's treating institutions well. Look at how strong this relative strength uptrend is. It's even more persistent than the price uptrend. So Hilton. Hilton is potentially in a important reaccumulation. 2018 was a year where I think it was largely avoided by large interests, and it had the thing that I like here is it made a higher low at the December low, which most stocks did not, and it had good run up and good leadership up to the highs. It may need to pause around the highs, but if it doesn't pull back much and doesn't pull back much with the market, I think this could be an excellent stock to look for the completion of a reaccumulation and a further markup. So did I do them all?
Let's see. Did you? Yeah, you did Nike. Did you? And you did AutoZone?
I believe so. Yeah.
Okay. Well, which of those would be your favorite? I mean, again, you have to pick one, and I know you liked a few of them.
Well, I like Starbucks a lot. I like the way it's built a big cause. I think it may be a campaign stock, and it's acting very well. It's showing good leadership, and given an opportunity for the market to show some weakness here, I think that that could flatten out Starbucks for a little bit and create an opportunity to buy it.
Okay. All right. I am going to take a little different approach here. So your answer was Starbucks, which I think is a pretty nice pick. I'm going to show you first an RRG. And what I did is I took the 5 stocks, their industry groups, and I put them on an RRG. And actually, I'm going to change this versus the XLY instead of the S&P. So let's update that. And so this is just showing you these different industry groups within consumer discretionary and how they've been performing over the last year relative to the XLY. And so as you can see, the ones I really want to pay attention to are the ones over on the right side of the screen, especially that strengthen, then go into weakening, and then come back into leading again. And so you can see the restaurant group right here that is absolutely soaring, even as the market was weakening back in the fourth quarter. You can see how restaurants were just absolutely crushing it on a relative basis. And then they got to a point where they were so stretched out here on the right-hand side, which is this relative strength ratio. They were, by far the best area in consumer discretionary. And then as the market rallied, they really haven't participated as much. But I think most of it was a function of the fact they were just so overbought already going into the period that I think this is like a reaccumulation type of a phase for the restaurant group. And what I suspect is going to happen is that we're going to turn back up here. Now, when I look at all the groups, and especially throughout this latest rally, you got to pay attention to footwear, the specialty retailers, and also over here, you can see the hotels not really looking good there, but keep an eye on what happens here to the hotel group as they start to turn back toward leading. But right now, you got specialty retailers, footwear, and the restaurant group. So I'm going to focus on those three. I think to maybe further your point earlier, Bruce, you were talking about Amazon. You really didn't like what was going on. Look at their industry group. The industry group has not been doing well, and obviously part of that is because of Amazon. But, of course, I also have another RRG chart, which shows these 5 individual stocks, and I've just got them relative to the S&P. I'll go ahead and leave that. But during the downturn, look at the one that took off, and it's the one that you talked about, Starbucks. And now that we've strengthened, Starbucks is weakening, but it's starting to turn. It's just starting to curl. So the point is we got to hold these for a year. So I want leaders, and I want some maybe that haven't performed as well on a relative strength basis recently, but have the ability to make that turn back to the upside. Look at what's lagging over here, Amazon. And throughout the year, Amazon was way over here on the right side, but look at what happened. It curled. It looked like it was going to go back up into leading, and then it just kept drifting. And when the market got hit, Amazon went into the lagging. And as the market rallied, where is Amazon? Just like you said, it has not been participating. So the first one that I would wipe out off of this list, and again, we're basing it on today's technicals. You and I probably both agree a month from now, we might come up with a different pick. And that's just the way technical analysis is. But based on today's technicals, Amazon would be the first one I'd throw out. And the two that I like the best, I think, are AutoZone and Starbucks. And so looking at the charts on these two stocks, I'm going to pull up AutoZone, and we're going to go with a weekly chart here. And I'm going to go back a ways. So let's go back really since the start of the bull market in 2009. And you can see AutoZone made this huge move up, sideways consolidated here for quite a while, 2.5 years, and then recently broke out to the upside. So I really like that pattern and formation. Well, Starbucks did basically the same thing, had the big move up, and for about 2.5, 3 years went sideways and then broke out. So I am almost down to a coin flip here on Starbucks or AutoZone. And I guess just to be different, I'm going to go with AutoZone, Bruce. I know you got Starbucks. I got AutoZone. So I think maybe what we'll do is go ahead and pull up that poll and see what everybody else is going with. And I was wondering if everybody would go with Amazon just because it's Amazon. And we're about to find out, and they did, Amazon. But, of course, everybody's also thinking, Bruce, that Amazon's been this great stock for such a long time. A year from now, things can look a lot different than they look right now. But my argument is based on the current technicals and what we just showed. I think Amazon is the worst performer of these 5. You have any other comments?
absolutely, Starbucks and AutoZone were my top two picks, and I think they're largely interchangeable. Both really good ideas. I love your analysis. I love the way you used RRG there, and very thoughtful approach. And Amazon could be in the process of building an important reaccumulation in here. If it is, I think it's going to be some number of weeks to months before we're going to know. And so it's just too early right now.
All right, well, we got another minute or maybe 2 minutes left here, so I'm going to bring in our special guest, and it is our producer of the show, Zach. I am putting you on record here. This is your first time giving us a pick since we've been doing StockCharts TV and Market Watchers Live. Which one of these 5 stocks would you buy to hold for the next year?
Yeah. So the the pick that I made was Nike, actually.
Okay.
Way to step up. Good job.
Yeah. And I picked Nike. I don't. Here, let me go ahead and back out of here.
Yeah, I was going to say, pull up a chart if you want. Take a look at it. I mean, walk us through. I'd love to hear it.
Go ahead and pull up a chart because I'm like that, right?
Just don't put a picture of your foot up on the screen.
My foot would be terrible. What?
Yeah, I don't want to. Well, I just don't want to see the Nike shoe. Is what I'm saying.
All right, let's see here. I have my Nike, or a Nike chart, I should say, going up.
Okay.
And so I would say about Nike is just that it broke out right now from its 52. Actually, it's not even 52-week highs. This is a weekly chart. These are weekly candles. So I would probably, if I was trading this, I wouldn't be buying it right now. I would be waiting for it to come down just a little bit more, but it did just on the weekly just pull back to that recent high right here, as you can see. And so that's why I was saying, yeah, I'll take a shot at it. So,
well, I mean, you're in a good area of the market. Footwear has been strong, and it's been one of the leaders, not just in consumer discretionary, but throughout the market. I mean, versus the S&P 500, I would say footwear has been a top 10 industry group for the last year or two. And with Nike, you've got one of the best stocks. So I can't really argue with it. I mean, what do you think, Bruce?
Honestly, this is what I was looking at right there. We have all of our SMAs going in the right direction, coming on up, and it's pulled right back down on top of the 20-day moving average.
All right. Well, we do need to wrap up here.
We actually have another 30 seconds, so longer than we normally do. So I'll let Bruce go ahead and respond.
That's because we're so efficient. Well, I just think it's a wonderful analysis. That was great and a great looking chart. I'd have trouble arguing with that analysis, and I really like the structure, the base structure that it made before this wonderful 2018 upward trend that it made. So I'd have trouble arguing with your selection.
Yeah, and I actually, when we put the poll together, there were 4 stocks I thought looked pretty good, and Amazon had not been performing well. So it was kind of like a deliberate thing, kind of throwing Amazon in with 4 stocks that I think look pretty good. The hotels group is starting to strengthen here in 2019, and Hilton's one of the best. So that we didn't really talk about, but that's been strong as well. Anyhow, we are going to wrap up. Bruce, thank you so much for coming in and taking Aaron's spot today. You did a great job. Always great to have you on the show, my friend.
Thank you so much. Great to be here.
All right, let's go ahead and wrap up. Do want to thank all of you for being with us today, and thanks for participating in that poll. That was fun. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here tomorrow. Happy trading.
Here's how to put a simple line on your chart without using the annotation tool. Let's say we want a line in here at 47.50. You can just drop down here into the overlays, pick horizontal line, add the price point, 47.5, and we're going to use a red line. We're going to make it solid and thick and hit update, and that blasts it into the middle of your chart.